everyone, and welcome to this of the Insurance Experts. It's my pleasure to have a special guest speaker on the line, Daniel Cruz of Health Partners. He's an actuary like I am, and that's actually how we met. We used to work together as actuaries. Daniel's a passionate advocate for the individual health insurance marketplace, and I wanted him to share with us today a special new arrangement, the Health Reimbursement Arrangements, HRAs, and there's some new rules around it that he recently wrote an article about. So Daniel, could you please first introduce yourself and tell us a little bit about your background?
Sure. First, thanks for having me on, Mark. I really appreciate it. I work for a company called Health Partners. We're out here in beautiful Temecula, California, and we are healthcare consultants. We work with health plans, brokerages, health insurance companies, you name it. Anything in the healthcare sphere, we're involved in. And as you mentioned, my particular passion is the individual market, and that's what we came here to talk about, some new opportunities that both relate to the small group market, large group market, and the individual market.
Awesome. Well, tell us a little bit more about an HRA. What exactly is an HRA?
Sure. So an HRA is a health reimbursement arrangement, and it's essentially part of our tax code, and it's a way for employers to funnel funds to their employees in order to pay for medical expenses, or now there's some expanded opportunities to pay for actual healthcare coverage in the individual market. So it's a way for employers to pay for this on a pre-tax basis.
Okay, and I know a lot of people have heard of HSAs, health savings accounts. What's the difference between an HRA and an HSA?
So there's a couple of main differences. Number one, the HSA is tied to a particular type of health plan. So if you're an employer and you're offering an HSA, it has to be tied with a high deductible health plan. So it's very limited in the sense of what you can pair it with. In addition, HSAs are owned by the employee. So any amount that's put into the account, the employee owns it and can take it with them when they leave their employer and go to another job or don't even get a job afterwards. That health savings account stays with them. HRA, on the other hand, doesn't necessarily have to be tied to a particular type of health plan, and the type of arrangement we're going to talk about today can be any type of health plan with any type of cost-sharing arrangement, high deductible, low deductible. It doesn't matter. So there's less restrictions upon what it can be paired with, and on top of that, it's owned by the employer. So when the employee leaves, they're not taking money with them if they change employment.
Okay. So tell us a little bit about these new rules around HRAs. What's making them more attractive now?
Yeah. So the new rule is essentially an expansion of an old rule, which occurred in 2016 with the 21st Century Cures Act, that allowed a special exception for small employers with under 50 employees to fund individual market coverage. So if you were a small employer, instead of offering coverage and purchasing a particular plan and giving it to your employee, what you could do instead is give them a defined amount and allow them to purchase coverage on the open market. And that amount, at least the amount that was put into the arrangement or the account, was on a pre-tax basis. So this new rule, which goes to effect 2020, essentially expands that not only to small employers, but to employers of any size. It also eliminates some of the contribution limits. So in 2016 and up till 2020, there were some limits on how much you can contribute towards the individual market coverage. That's gone. So you can contribute however much you want. In addition, there's some additional tax benefits for the employees. If they were to purchase insurance off exchange, they're allowed to do so with a salary reduction that's also on a pre-tax basis. So there's kind of an additional tax incentive for both the employer and now for the employee side of their contribution towards the premium. So that's the new incentives added going forward in 2020.
So it feels like it's almost leveled the playing field from the group market to the individual market a little bit more.
Yeah, certainly. Yeah. I mean, if you think about the employer market now, if you're an employer, you're purchasing coverage for your employees. You're allowing them to contribute a certain amount. and both what the employee contributes, employer contributes, both of those are tax advantaged. And now they're kind of making that even for this individual market coverage, which gives a lot of more ownership for the employees. Now they're not just giving coverage from their employer, they're actually going out and purchasing it, having some autonomy, taking the plan they want, and if they change employment, they still have that coverage if they want to keep it.
Interesting. So which employers do you think are going to use it, and why they're going to use that?
Yeah, so that's the big question. I think the baseline expectation, and really, like I said, this was an expansion of a past rule. Not many small employers took up the original rule in 2016. So the baseline expectation is it may be the same, where not that many, a small percentage will pick it up. I think there's some added incentives, and it really matters who we're talking about. So I kind of look at this in terms of three different types of employers. The first is small employers that don't offer any coverage. So if you're a small employer, you're not offering coverage, your employees at this point have to go purchase individual market coverage or get it from their spouse. And if they're purchasing individual market coverage, it's all on a post-tax basis. It's after their taxes on their salary, and they're paying the full amount. Well, I think this is really where a lot of the value lies, is you can now give these employees money. It can be $500, $1,000, $5,000 a year. You essentially get to choose, but as soon as you do that, you allow then the employee, if they purchase this plan off exchange, now they get not only the contribution from their employer to go purchase it, but now the portion that they pay on top of that to actually get the coverage is also able to be done on a salary reduction pre-tax basis. So I really think that's where the biggest value is. The small employer is not currently offering coverage, which is actually a majority of small employers. So this is a big market and big value proposition for them. The second is small employers currently that offer coverage. If you look at the individual market and small group market, they're both age rated, they're both community rated. They really compete with each other. And when I looked at the premiums in about 15 states nationwide, there's actually lower premiums in the individual market. So even if you're offering coverage, there's still opportunities to look out there and say, well, what about that same health plan in the individual market? You might be able to find a 10% reduction that saves you money and saves your employees money. So I think that'll take a kind of a deeper dive in analysis. And the third employer group is that large employer that did get expanded. This got expanded to them. I don't see great value in this, because typically a large employer is going to be experience rated. They're going to have better health status than the individual market, perhaps 20% cheaper premiums. But there may be some large employers that have bad risk, and they're bleeding out expenses from covering all their employers. And if they were to look to the individual market, they could save their company money and stop the bleeding. So there may be some opportunity, but it's really the outlier large employers that have bad risk that would potentially find value in this new arrangement.
Right, and I can tell the health insurance market is different in every state, and as you can tell, sometimes the individual prices are better, sometimes the employer prices are better. This is why you really need to work with an insurance expert, a specialist. And Daniel's available. He consults with these brokers to help them identify where the value is. So thanks for joining us today and sharing this new rule. I think it'll be interesting to see where it goes and the uptake of it. And appreciate you being with us on the Insurance Expert today.
No problem, Mark. Thanks for having me on.
Talk to you soon.